So, here's a terrifying thought. Imagine you gave your friend $100 to hold on to for safekeeping. When you asked for it back a month later, they handed you $95 and said, "Thanks for the business." You'd be furious, right? But we do this every single day. We do it with our checking accounts, our savings accounts, and especially with the plastic cards in our wallets. The modern banking system, whether you're in New York or London, is designed to slowly, quietly, and legally bleed your wealth dry. Welcome back to the Subject Simplified channel, where we take complex topics and make them easy to understand. Today, we are pulling back the curtain on the free banking myth. Their business model relies on you not understanding how the math works, and we are about to change that. Let's start with the checking account, or current account in the UK. This is your money's holding bay. For my US friends, you know the big four banks often charge a maintenance fee, $12, $15, unless you meet some crazy minimum balance. When you slip up, boom, maintenance fee. According to the Consumer Financial Protection Bureau, U.S. banks have historically raked in over $30 billion a year in overdraft and non-sufficient funds fees. That is a tax on struggle. Now, UK viewers, you feel smug with your free if in credit model, but nothing is free. Banks pay you 0% interest. With inflation historically high, leaving your money in a 0% checking account is literally setting a match to your purchasing power. Plus, UK banks have charged effective interest rates of over 40% on unarranged overdrafts. 40%! That's not a service, that's a punishment. The checking account is just the entry point. The real illusion happens with savings accounts. We grew up hearing, "Put your money in the bank to grow." But today, it's a joke. Most traditional brick-and-mortar banks in the US and the UK offer an APY, that's annual percentage yield, of something insulting like 0.01%. Let's do the math. $10,000 at 0.01% earns you $1 after an entire year. Meanwhile, inflation eroded $300 or $400 of your purchasing power. You lost wealth safely. I know rates have gone up recently, but many major banks still lag far behind the base rate, and when rates fall, guess whose savings accounts drop first? Here's what they really don't want you to know. While they're paying you 0.01%, they're taking your money and lending it out to your neighbor for a car loan at 7% or a mortgage at 6%. The spread is their massive, quiet profit margin. They're arbitrage machines, buying money cheap from you and selling it expensive to borrowers. Okay, let's talk about the sharpest weapon in their arsenal: credit cards. I love credit cards for the rewards, the points, the cash back, but the banks know that for every optimizer who pays off their balance in full every month, there are 5 people who don't. That's the revolver trap. Credit card debt is at record highs, over $1 trillion in the US alone. The average interest rate? Hovering around 20 to 25%. Einstein reportedly called compound interest the 8th wonder of the world. He who understands it, earns it. He who doesn't, pays it. If you only make the minimum payment, you will pay for that $20 pizza for the next 6 years. But here's the scam that affects everyone, even if you pay off your bill in full: the interchange fee or swipe fee. Every time you tap your card, the merchant pays 2 to 3%. Retailers bake that cost into the price of goods. So everything you buy is 2 to 3% more expensive. When you get 2% cash back, you aren't winning. You're just clawing back the surcharge that had already been added to the price. And we have to talk about the psychology. An MIT study showed that people paying with a credit card were willing to pay twice as much as cash buyers. Twice as much. It's called the pain of paying. When you hand over physical cash, the part of your brain that processes pain lights up. You feel the loss. When you swipe a card, nothing. It's painless. Banks know this. They want to remove the friction so you spend more, carry a balance, and pay them 25% interest. So the system sounds rigged, but you don't have to be a victim. Here is how you opt out of the scam. Number 1, fire your big bank. Look at credit unions in the US or challenger banks or building societies in the UK. They're member-owned, and profits go back to you in better rates and lower fees. Number 2, stop accepting 0.01%. Move your savings to a high-yield savings account, HYSA. Online banks don't have the massive overhead, so they pass those savings to you. Right now, you can find accounts paying 4 or 5%. That is 500 times more than the big banks. I've linked the best offers in the description below. Number 3, treat your credit card like a debit card. Set up autopay for the full statement balance. If you can't afford to pay it off, don't buy it. Don't let them harvest that 25% interest from your future labor. The banking system is a tool. Don't be passive, be active. Move your money where it's treated best. If you found this breakdown helpful, please consider subscribing. We are building a community here of people who want to take control of their financial lives, and I'd love for you to be a part of it. Remember, here at Subject Simplified, we take complex topics and make them easy to understand. Thanks for watching, keep your money safe, and I'll see you in the next one.